Get ready before life happens. The podcast helping you navigate life's what ifs.
Welcome to Get Ready Before Life Happens. I'm your host, Tony Stewart. Today, I'm joined by Maxwell Schmitz, disability insurance specialist and co-founder of Dingo Technologies. Max, welcome to the podcast. Great to
Thanks
have you
again.
back.
Thanks for having me back, Tony. Appreciate it.
Yeah, I always appreciate your time and your insights. So, just for people who are not familiar with you, tell us a little bit about yourself, your origin story, and how it inspired you to focus on disability insurance.
Yeah, so kind of looking back at my life and my immediate family, I think you can pretty much say I'm among many people who fit the bill for being an insurance poster child. We've got so many different types of insurance that my family's used, and it all has kind of come to formulate where we've dedicated our focus to in the last couple, decades here with our family business. So just to sort of iterate on that a little bit more or dive in a bit more is so my grandfather started our agency called Bay Area Disability Insurance Services back in the late 70s. He passed away in the early 80s due to kind of an unforeseen medical condition. So right then and there, you've got a beneficiary and a need, certainly a need. He did not have enough life insurance. And that his wife, my grandmother, she eventually was diagnosed with Parkinson's in the early 90s. So she ended up needing long-term care. And of course, we didn't have long-term care insurance quite to the same level as we have available this day and age. So that was something that they did not plan for. She had to sell her house, ended up in sort of like she ended up in a Medi-Cal facility or Medicaid facility. And then my dad had a heart attack, after I joined the business. This must have been back in 2012, 2010 maybe. And so he was the beneficiary of a critical illness policy because of the heart attack episode. And that, it was kind of a wake-up call for as far as his lifestyle and determining, how much he needs to work and things like that. It was definitely getting to him physically. And then my mom eventually had, and she was working with us as well. She's still working through a pretty significant disability that's resulted in a lung transplant. And, she's really currently rehabbing a broken femur right now as a result of some of the drugs that she had taken for the lung transplant. It sort of creates these difficult breaks on their bones. So from an insurance poster child perspective, I mean, this stuff is everywhere. And I don't want to make it sound like we're a unique case or like I'm a unique case or my family's a unique case, because this is the reality of just life in the United States, certainly. But I mean, it's really around the world where we see people undergoing unforeseen health issues. We're not necessarily dying from them quite at the same clip as we were certainly in the 19th century or 20th or even 20th century. So it's a different world out there. You have to navigate a little bit differently. And our focus here on the disability insurance side has really been our calling card over the last 20 or certainly 15 years that I've been in the business. But working on the disability planning elements between your pre-retirement disability need, which looks more like DI, and a post-retirement disability need, which looks a little more like long-term care insurance.
Yeah, well, that's, I mean, knowing your family and going so far back with your family is, yeah, all the events is, your family has pretty much used every type of insurance coverage that I can think of. And, so when you talk about that, but I think when we think about all of our families is we can think about either that they did use a specific type of insurance coverage that you've talked about, or that they could have used
Right.
that type, and it sure would have come in handy. And so for people who are listening around the world, is when Max is talking about disability insurance, it may have a different name in your country, is the disability insurance while you're working is income protection insurance, and the long-term care insurance is the insurance to pay for your long-term care needs. And depending on your country, some of that is covered, by some governments in some more enlightened countries around the world, and in other countries it's not. So I'd urge you to check, and find out what the resources are in your country. So with that little digression there, for people around the world, is what we're going to be talking about are concepts that are applicable around the world to think about. So when you think about what you get from the government, what you get from your employer, or what you get privately, the concept is to make sure you have all these things in place, no matter the source. So thanks for bearing with me, Max, while I went on that little description there. But I think that's helpful for people because, the main reason I want to do this episode specifically is you and I have talked about this a lot. We talk about a financial plan. Financial planners say that a financial plan is complete. However, is a financial plan complete without disability insurance? Why do you feel that a financial plan without disability insurance is not really a financial plan?
So there's really kind of two ways to think about disability insurance, at least the framework that I think of commonly, which is to protect your lifestyle and cover your bills. Make sure your living expenses are covered, and that's super important. I mean, that is like level one type of planning. And then the secondary component is protecting your potential earnings for the rest of your life. And your life, as far as your earning potential goes, could end at 65. It could be, less if you're planning an earlier retirement. It could extend, to 80 or beyond in some situations. So making sure that there is a plan for recouping the lost income through all those years as well, because the, disabilities, while they average around 5 years per claim, it's one of those things where you're going to see, still a significant portion, 20% or more, going beyond that number, or more than 50% are going beyond, 5 years, just due to the averages. But you're going to see plenty extend well beyond that. And you want to make sure that your clients are really the ones who are well taken care of during those moments, so that they don't have to spend down their assets. So an example, just to put some numbers on it, would be a 30-year-old, let's say, who's making $100,000 a year, is, spending probably, I don't know, credit card bills, and just daily expenses, maybe some student loans, potentially a mortgage, if they got in early. There's a good amount of money that they're probably spending. If it's a dual income household, maybe they'd be looking at something between $6,000 to $10,000 a month of spending. And so in that situation, you'd want to make sure that you're recouping as much as possible so that you can continue that lifestyle. But on the back end is the bigger calculation here, which is if they're 30 years old, planning to work until age 65, well, that's 35 years of potential income that they have yet to materialize. And so when we're doing that planning, I mean, the back of the napkin planning is, okay, he's making 100,000. If we don't price for any increases or anything like that in his salary, that's still $3.5 million that of lost income, right? 100,000 times 35 years. So obviously there's going to be inflationary forces and, raises and performance bonuses and maybe some, creating businesses, selling businesses. There's a lot of variables here, but the back of the napkin math clearly shows that this is a multi-million dollar exposure point. And when we're talking about financial planning, we need to be able to assess risk pretty clearly. And this is just a really simple way to calculate what we call their net worth, their future, their unrealized income potential at this point. So that's something that I think a lot of planners are overlooking in the process.
Yeah, that's one thing that's really struck home when you and I have talked is that, you first think about the expenses and making sure there's enough coverage to cover the expenses. But what I really started to focus on, that a big part of financial planning is planning for financial independence or retirement. And if you don't have your income, you're also not saving for retirement.
Mhm.
So you're not going to meet any of those goals that you put forth in a financial plan if you don't have disability income insurance. And so, just for people watching and listening, the point of this episode is not to sell disability insurance. The point is to you to think about the different holes you may have in your planning. And as you mentioned, it's a risk exposure, and that's part of a financial plan, is to cover all the foreseeable risks. So whether or not you use a financial planner, even if you're using Chat GPT, is, to do your financial planning, which I do not advise. Chat GPT is not a financial planner, but let's say you are, is you want to make sure that you're thinking about your risk, because when you get in a car, you assess the risk of driving. You put on your safety belt. You check your mirrors. Well, hopefully you look both ways. You stop at stop signs. We know some people on the road don't do that. Of course, we're all great drivers. It's just everybody else on the road is not a great driver. But you're constantly assessing your risks and you're adjusting them accordingly. So that's something that I think is really important. So, Max, when you work with financial planners, how do you get them to start really thinking about including risk assessment uh, in this nature?
Yeah, so I created this platform called Dingo with the express purpose of helping advisors and brokers be able to just plug into this type of conversation without any forethought or foresight in terms of understanding who the client is or anything like that. It's very turnkey. You just pull it up and enter, a few of the key basic demographic information from this particular client who perhaps you're meeting with virtually or even at your office, and just going through that natural conversation. So we'll ask them, what their income is. That's kind of the first stage, what their age is, what their occupation is. That'll come into play later. And then it will simply move through this analysis that we just talked about. So there's a monthly lifestyle analysis. We want to make sure that, they understand what their monthly nut is, and that they're able to bring that in, whether in sickness or in health, and that extends beyond just paying the bills too, right? There's really kind of a familial obligation there as well for especially if they've got kids or anything like that. I feel like a lot of my peers were very resistant to the fact that they have to be responsible for their own lives financially, that maybe there was always mom and dad to kind of pick them up and help them out, but that expires after a period of time. And so, having this long-term planning in mind is really important. And then it walks directly through this future net worth calculation, which gets pretty granular. It asks for existing savings, and we're usually aiming for like retirement savings, liquid retirement savings. So whatever's in their IRA or Roth or any sort of taxable brokerage account, just kind of Bitcoin, whatever, throw it all in there, and designate kind of an estimated rate of return for that for that that all those assets, and make sure that we're also assessing for a contribution each year, which could be 10% of income, 20% income, maybe more. And that's ideally what people are going to be stashing away and continuing to contribute to their retirement assets. And then it's going to allow you to play with a hypothetical disability scenario where you're going to designate the age of income loss or disability, and then it tells you what your runway looks like. So how long is this asset going to last? If we're going to pull off 100%, 90%, 50%, you can designate it's a slide rule type of tool. So you can designate what percentage of income you want to replace. In other words, what are you going to be pulling from the account here? Are you replacing 100% of your income from the account? Okay. Well, if you're making 100,000, that means we're going to pull out $8,333 from this account every month, or 100 grand a year, to basically replace your lost income. And if you think maybe we can live off of 50% of that, then you just toggle it back to 50, and it'll show you how long your asset is going to last. So really simple stuff. I mean, it's granular in the sense that you're getting the right data, but it is really just a one kind of page visual that clients seem to really understand and helps them resonate with this potential loss scenario and showing them the true exposure at risk here. So Dingo is an easy way to establish that. I also just set up a quick yet worth calculator for people to use for free. It's just what's my dot yetworth.com. So WHATSMY dot yetworth, YETWORTH.com. And you can calculate your future earning potential very simply using four different fields. It's a really simple stuff, basic math that I think every planner should be incorporating.
That's great. And just full disclosure to everybody watching and listening, I'm an investor and advisor to Dingo Technology. So I do have a little bit of a dog in this race, but it's because I really believe in this concept is that we need to really include disability insurance and protect against the risk of a lost income, because without that, as I've mentioned, your financial plan is going to fall apart because income is what makes the assumptions come true. And for everybody watching and listening, if you have access to the show notes, those links that Max mentions will be in the show notes, so you'll be able to find those in the show notes. So, Max, why do you think that so many financial plans just overlook disability insurance? I mean, it should be part of it. CFPs, one of the pillars is insurance. Why do you think it gets overlooked or underplayed?
So there's so many factors I think that play into it, but I think the primary ones are they don't know where to go. There's not enough insurance people who specialize in just the insurance side of things. They're out there for sure, and that, I'm not saying people aren't doing this, but they're kind of hard to find in a certain sense, where, a lot of insurance advisors out there are also trying to establish assets under management. So you're sending them to competitors. If you're a financial planner, that's usually kind of the setup there. So there's really not an easy access point for people, which is why I think Dingo is really kind of well established to help with the analysis piece of it. And then as far as client access goes, I mean, there's really no simple way to just get your own policy out there. You have to work through a broker. As I just mentioned, these brokers are kind of not hidden's not the right word, but they're not on every street corner, certainly not a disability insurance specialist. And sometimes you'll be able to find a PNC broker who offers a disability policy, or kind of has access to a disability carrier. But then you're only getting one real look, and it's definitely not the industry it used to be, in the sense where it had 50 or more insurance carriers, 100 plus insurance carriers at one point in the DI space. But now there's still a good 7 to 12 that I think are in the mix in any given case. So access is a big issue. The ease as well. I mean, this is all typically fully underwritten stuff, but you do have a pretty pretty lively and healthy group disability marketplace as well. So I think a lot of folks think that their group coverage is going to be enough to get them through the day, without truly understanding the fine print that comes along with these group disability programs that are, they're not even paying for, but that their employer is offering. So we could probably double click on that too if you want to get into that a little bit more. But between the lack of access on the individual marketplace and the kind of this myth that group disability coverage is as good as gold, those two things are probably the primary reasons why advisors just sort of skip over the disability part of the planning conversation.
Well, for me, obviously access is a huge issue, but that's not one we
Right.
can really address or help out. I mean, that's what we're trying to do with Dingo Technologies is help solve that issue. But I think the bigger issue, and this is one I always encountered when I was working with financial planners, is group disability insurance is enough.
Mm.
And that is not true. So
Mhm.
let's jump into that. Tell us a little bit more about that.
Yeah, so I think the main kind of ways to understand a group disability policy right out of the gate is to figure out, okay, what percentage income replacement are we looking at? What's the monthly benefit, what that maximum benefit look like? Um, is it portable? And who's paying the premium? Is it going to be, because that's going to influence whether or not it's taxable. And then the last thing is, could be the most important, is after you understand what percentage of income it's replacing, it's how do they define income? Is it going to be salary? Is it salary plus bonus? Is it all sources of income? So there's a few things that you have to kind of read into these policies. So let's say we're kind of looking at sort of a standard issue mold type of policy where you've got 66% of salary, up to a maximum of $10,000 a month. So some person who's not necessarily educated in disability coverage might say, "Oh, I'm good for 10,000 a month," or 66% of my income up to 10,000 a month. I've got solid coverage here. I can live off 10,000. The reality is that 66% again is based off of salary in that situation. So if your salary is again 100,000, we'll just use some easy numbers here. It's going to be 66% of that monthly number, which would be 8,333. So now you're looking at, about 5,000 of potential of benefit. And based off of that number, you're actually going to qualify for even less because it's going to be taxable if your employer is paying for the coverage. So typically what happens is the business is paying the premium and they're deducting that premium as a deductible expense. It's an employee benefit. They don't, they get to basically remove that tax liability for the premium that they've paid into it. And therefore, Uncle Sam is going to need to get paid through the benefit that gets paid to the individual on claim at claim time. So that 66% up to 10,000, maybe you thought it was 10,000 of coverage. Well, it's actually 6,000 and change less taxes, which is going to put you down closer to 4,000 probably. And so now suddenly you're looking at half your income. And, I don't know too many people who are keen on living off of half of their paycheck. It's funny because if you're taking this approach about, okay, I can live off of half my income, that's not a huge problem, we'll make it work. But if you flip the script and say, okay, well, what if your employer, without introducing the subject of disability whatsoever, if somebody came up to you and said, okay, you're taking a pay cut tomorrow, it's going to be half your pay, that would be like a war crime, basically, in your household, right? You would flip out. You would be like, that is completely unbelievable. There's no way I can survive off of this. This is, yeah, it's a different type of energy that comes into play, depending on, what the framing of that looks like. So I think just understanding the formula there is really important. Understanding what income is, so salary. Again, if you're more accustomed to we see this a lot in the tech space where, they have really high salaries relative to the rest of the nation, but their salary is only going to be maybe 50% of their total income because they're also getting a bonus. And you see this a lot in sales too. So any sales professionals relying on group disability, not going to work because of that commissionable or bonus in some cases income on top of that. But really in the tech space where you have these restricted stock units that are also a form of compensation, those, guess what? If you become disabled, you're not getting any more restricted stock units either. So that extra 500,000 of restricted stock units you get paid every year is going to go bye-bye. And therefore your planning needs really sort of change there as well. So it's another form of income loss that I think a ton of planners are overlooking from a disability perspective.
Yeah, and I agree with you. Is that something that, has come up often in discussions is like, okay, there's not as much as you think there is. And, like you mentioned, there's the tax impact that people sometimes overlook. But as I mentioned earlier too, you have the impact of not funding the retirement plans because what you were talking about, I can survive on half the income. Yeah, you could pay the mortgage, but you won't be able to get a new car.
Right.
You may not be able to continue to put your kids into the school you want to put them into. You may not be able to go on vacation. Yeah, you're going to survive
Mhm.
on half your income probably, you know, but are you going to really be able to meet all your goals and live the lifestyle you want to? And that's the difference when you're talking about protecting against any of your risks. It's like, let's think about your homeowner's insurance. Is if something happens to your home, would you insure it for the full amount, or would you be happy to insure it for half the amount? I
Right.
mean, yeah, you could survive. You can move into a house that's half the size if your house burns down,
Right.
but is that what you want? And I think that's what we're talking about here is that we need to reframe that. I think the other big reframing that we need to think about is shifting the conversation from disability income protection. You and I have talked about this also a lot is, people think about disability and it's like, nobody wants to think about disability. I don't want to think about disability. It's frightening. You know, it's not called the death
Yeah.
insurance
Right.
industry. It's called the life insurance industry. So, how do you think we can start to reframe the conversation to have a more positive light on it?
Yeah, I think that, I mean, this was a real big reason why we actually rebranded from, I mentioned our company was founded as Bay Area Disability Insurance Services. And then after my grandma had her stint with Parkinson's, my folks changed the name of the agency to DI and LTC Insurance Solutions. But that, it's a great name. It said what we did to people who are in the know. But for most consumers, that was just like an acronym salad, and so it didn't really work as far as name recognition, brand recognition, and stuff like that. We were getting mixed up with all the other DI blank and so and so, and so the establishing the name as Yetworth was really kind of important to us because it's a concept that I think should be inherent, kind of like, sort of like how we talk about Kleenex. We want to be the Kleenex of the insurance space, right? Where everybody is using this term yet worth, and you lose kind of trademark status and stuff like that. So there's smart people who tell me that's a stupid strategy, but truly at this point, I want more people to be using the terminology yet worth because it's really about the future net worth. And I think, the way you described it with the homeowners is perfect. And you kind of touched on it with the auto as well. It's just like you think about your full, your why we have this coverage. Like, yes, if you've got millions of dollars in your bank account, you don't need auto insurance, technically, right? You could self-fund that completely. Homeowners, same thing, right? You have people who are, they're worth tens of millions of dollars and they still have homeowners insurance. And it's like, why would you do that? It's the same concept here, except the asset is significantly bigger, right? So yes, you could potentially, survive through that 50%, but you don't have necessarily the same, certainly the same lifestyle and the ease of getting to that financial terminus or that goal that you've been saving up for all your life. Truly is a lot more in reach if you have the right type of coverage in play. And one other thing to tack onto that is, if the income asset is significantly bigger, that future net worth is significantly bigger, your yet worth is significantly bigger than your home and your auto assets. However, but on top of that, I should say, not however, but on top of that is it's much more likely to occur that you would need this coverage than totaling your vehicle or a total loss on your home. A total disability is significantly more likely. So it's like it's one of the biggest assets. It's what I call like an atomic asset because we're talking about these little assets and stuff that are, they're particulate. They're important for sure, and you need that steadiness in your life, and that type of coverage is important. I don't want to minimize it, but we're kind of losing the forest for the trees here. The real thing that you need more than anything financially, and I'll say arguably, but I don't even think it's arguable at this point. Your income is the whole point, right? Even your savings, right, is ultimately it's designed to produce income. That's why we are saving the money that we're saving for retirement. It's an income-based asset once you get to retirement. So it's that income that drives absolutely everything. So I think you're smart to sort of pivot to that income type of language. I think lifestyle is another good one. Livelihood is one that we strongly considered as well when we were sort of going through the rebrand process. I kind of like this image of Jack and the Beanstalk too, because at the end of the day, people sometimes mix up the fairy tales, but do you remember why Jack went up the beanstalk and why he went back up again?
Not really.
It wasn't just to rile up a giant and and to mess with his stuff and vandalize his stuff. He was out there to steal the golden goose, and the golden goose
Oh, that's
produced the
right.
golden egg. And so when he came back down with that golden goose with that produced the golden eggs, that's kind of like the income story here. People that's worth protecting. That's why the giant was getting all angry and huffy and came down, and ultimately, the axe hit the beanstalk and the giant fell from the clouds. But there's this imagery I think that's really kind of palpable in that story where at the end of the day, he just wanted financial security. He sold the cow for the beans, and that cow represented financial security to his mom, who was kind of playing small ball, and threw him out of the house when he came back with the magic beans. How ridiculous, right? But at the end of the day, he was just trying to, it was a risky trade-off, but he found his way into the clouds and secured the golden goose at the end of the day.
I hadn't thought about that in that. Like,
Yeah,
is Jack and the Beanstalk is a financial planning tale
that's
or
right.
or a
And
warning
income.
story. So, with the access issue and everything else, is there a way that advisors can better integrate income protection into their holistic planning at this point?
Yeah, I mean, obviously there's a natural plug for Dingo. It's just tailor-made for this, right? So I have to say that. But you don't necessarily have to go full board at Dingo. You just need to implement a process. And it's as simple as first of all, understanding that you're already doing some level of disability planning. Believe it or not, most advisors, if they're true holistic financial advisors, they're talking with their clients about getting a living will put together, powers of attorney, healthcare directives. This is all part of the process. It's probably on some form of a checklist somewhere when they're doing their client onboarding. And just add literally one more question to that, which is, do you have a plan for your income in the event of these events? So it doesn't even have to be phrased awkwardly like that. It could just be living will, power of attorney, healthcare directive, income strategy. Just leave it there and say, what is your strategy for maintaining your lifestyle if you have to use your POA, your living will, and your healthcare directive? What's the game plan from that point forward? And 10 times out of 10, they're going to have no idea what their plan is. Maybe they say, oh, I have group disability coverage through work. But that really necessitates a bigger conversation around, okay, well, let's get it granular with that and really dive into the weeds on your group disability plan. Can you contact your HR team and send over your benefits packet so that we can read through that? So it's really simple. I think we tend to overcomplicate this stuff because, job security and stuff like that, but it doesn't have to be like that. It could just be, if you're not going to use Dingo, just add that one extra line there on your client onboarding. What's your income strategy?
Yeah, that's a great thing to add, and it's something that can really make a real difference in your clients' lives.
Mhm.
And for people who are financial educators who are watching and listening to the show, is start talking about this as part of your financial education. This is as important as talking about different investing strategies, um, is to talk about making sure that people are learning about their insurance and about protecting the risks that can occur to them. Insurance is a topic that needs to be covered. It's boring, it's unexciting, but it's usually the boring and unexciting things that make all the difference in the end. Those are the fundamentals, and disability insurance is a fundamental component of a sound financial plan. So, Max, let's wrap up with what I call the Get Ready Hot Take Trio. These are three questions that I ask all of my guests. The first one is, what's one myth you're trying to break about disability insurance?
Oh, goodness. So we talked about the coverage at work. I think that's probably the biggest one, but I'll hit on something else here, which is just the true nature of disability in its own right. So what a lot of people think of when, again, I'm not talking about financial advisors necessarily, but clients who are coming, through, off the street through your door, they have to, you have to understand disability is a very loaded term. And so when we're talking about disability and why I think it's probably better to use the terminology income protection, like you mentioned, is because disability sounds so heavy and kind of outlandish, I think, from like a probability perspective too, because of the association with, like a water skiing accident or, getting hit by a bus. Like that's kind of where people go with this. It's like, oh, I can't walk anymore. And so this, like, that's so random. Like that, yes, it happens to people, but that's not like, why would that affect me? Um, and so it it it's sort of like this scrambled egg type of like planning. They just don't really understand, why we're going through this. And so the better, I shouldn't say better, but the approach I would recommend is to just kind of talk through it and ask if there've been any if they've ever given to a GoFundMe campaign, because that you'll find is the way people are dealing with disability now more than ever. And it wasn't like this is a brand new thing. It used to be like bake sales and other other types of fundraisers for people's families who are going through a time of need, and we still see that. Obviously, there's I'm not going to point fingers. It's in poor taste, but there's a serious lack of planning in American society, and so for these types of for these types of tragedies, and so life insurance, disability insurance, that's all obvious stuff to most financially literate people, but it's not getting done on an individual basis. So asking if they've seen or contributed to any GoFundMe campaigns, I think kind of gets them more in this mode of understanding of what a true disability is. Where I just saw one at my coffee shop a couple weeks ago, big plaque up there for one of the barista's daughters is, going through chemo and radiation through a cancer episode. And, she's got bills to pay. Everybody says it's medical bills. The reality, if you really examine that, is their medical is primarily covered by health insurance. That I mean, I'm not going to say the health insurance system in this country is good. Far from it. However, I think there's really a lack of understanding in terms of how this debt and how these hardships arise. It's not necessarily the $100,000 medical treatment. I mean, maybe you come out of pocket 13, 15,000, something like that in like, a pretty serious scenario where somebody who has health insurance. What's happening is they have the health insurance, but on the back end of that recovery is this income loss. And that's where they're racking up the debt. It's not necessarily the medical bills that's creating this debt in these desperate situations that you see on GoFundMe. It's instead the income loss. And I think people just are really missing the mark on that. So we need to sort of help people anchor in that, it's not medical debt necessarily. It's debt from a medical episode, which is a disability. So it's really, disability coverage could probably be better explained as medical leave insurance, because you're going to step away from your job and a lot of your daily life to focus on your recovery. And when you do that, there's an income loss coming into the forefront. And so this is really the whole point of DI at the end of the day.
I think that's powerful because, like you mentioned, it's not all permanent total disability.
Right.
Most people, like you mentioned, the average, duration of a disability is less than 5 years, and it's not always total. As people go back to work, first 2 or 3 days a week, and then they ease in. But if you're only working 3 days a week, guess how much your employer is paying you? They're paying you for 3 days a week. They're not paying you for 5 days a week just because they are. They're not going to. So I think that's a really key point for you to that you honed in on, and that when people have these GoFundMe campaigns, there's so many other things. They have to cover their rent, all the other things, because your health insurance is not going to pay for your rent. And we're not going to get into health insurance and long-term care. That's a whole other topic and a whole other podcast episode. So the next question is, let's get out the time machine for a minute. If
Yeah.
you could go back in time, knowing what you know now about disability insurance, what would you tell your younger self?
Oh man. Um, Gosh. Okay. So what I would need to know, hmm, I think what I really struggled with at the beginning of my career was understanding the gravity of what we do. Um, and so I wasn't intellectually curious enough to truly understand why disability income is so important. And I'll give you an example. I got involved with NAIFA very early. That's the National Association of Insurance and Financial Advisors. I'll just leave that there. But with NAIFA, there's there was a lot of older planners in my local, financial planners in my local who sold a lot of life insurance and stuff like that. And so they would tell me, "Oh, I've got, all my clients have a lot of life insurance. Why would I need disability insurance?" And I'd just be like, "Okay, I get it. If they're doing the planning, you're a lot smarter than I am. I trust the expert." Well, when you really examine what's happening, there is no planning being done on the disability side. What they're doing in that particular instance, I can think of this man, he's probably really old now, but he was basically selling a bunch of life insurance, permanent life insurance that was accumulating over a long period of time. I mean, whether or not it performs to what was illustrated, I think is a whole nother subject, but it's an uncorrelated disability insurance has zero market correlation, whereas, life insurance is often sold as this uncorrelated asset. There's performance metrics in there that I think are actually more correlated than we care to admit. But disability insurance, the only indicator, the only trigger for that, the only way you can access it, but also um, in a good sense, the way you do access it has nothing to do with the market performance. It's based on what you applied for when you submitted your application and accepted your policy. So it's a predetermined benefit. And so I think having that defined benefit aspect is super important compared to these life insurance plans, which some of them do have, disability riders and things like that, chronic illness riders. Um, but if you look at the fine print with those types of policies, they never tell you how much you're going to get because they don't know. They have no idea. You have no idea. They have no idea. What happens is you go through underwriting at time of claim, and they determine how likely you are to die. If you're very likely to die, like in my mom's case, she was able to access a good portion of her death benefit. But guess what? They kept a large portion for themselves too. The insurance company takes a fee from your insurance benefits, from your policy. So there's a whole lot more fine print there. But if it's something more like carpal tunnel, if you're a surgeon, you have carpal tunnel, guess what? You're not getting anything from your life insurance policy from a chronic illness rider, at least maybe the cash value if there's enough built up in there. But the chronic illness rider isn't paying anything because you're not considered chronically ill by their tables in some cases. And by the way, do you want to look at the tables? Because they don't exist really. They change them. It's not actually in the contract. It's not in the contract, which is just I I don't know how you could buy something and tell somebody that they're or sell something and tell somebody that they are set up with a disability plan when it's not contractually guaranteed. That blows my mind how often that happens in this country. Um, so not trying to get too hot-headed here, but the idea is there's so much fine print on the life insurance side that I think people are really struggling when they're met with the reality that there's no real disability benefit here in my situation. So just something to be aware of.
Well, I think it's like anything is you have to understand what you're actually buying and you have to actually ask questions to make sure you're getting what you think you're getting.
Right.
And we can talk about that with insurance. And people who've watched and listened to me for a while have heard me talk quite a bit about these issues with the life insurance industry.
Right.
And I agree with you wholeheartedly, but it goes beyond that. It goes when we look at any financial product is we don't think about the ramifications and everything that's involved. Student debt is a huge issue for the same reasons. I have a friend, Vicky Vollweiler, who's been on his podcast, who talks about how you can shop from college to college. That two students at the same college don't pay the same amount to attend that college.
Mm.
So it's the same thing. Is some kids are going to qualify for a merit grant, or some kids are going to qualify for this discount or that discount. So I won't go off on that tangent because we're talking about disability insurance. But the point is you have to understand what you're actually trying to accomplish and to make sure you have the right tool to accomplish it. And that's what I think you're talking about with a chronic illness rider. It is not a disability insurance policy. An accidental death and dismemberment policy is not a disability policy. There's a reason why accidental death and dismemberment insurance is so cheap. It's because the insurance companies are pretty much certain that they're not going to have to pay out a claim. So you have to think about that. That's why disability insurance is more expensive, is because the insurance companies feel there's a pretty strong likelihood that they may have to pay a claim. And insurance companies, if they have to pay a claim, they need to charge a premium for it. So
Right.
get off the soapbox here. So to wrap up, this is the wrap up question, Max. What is your number one tip for changing the way we think about disability insurance?
Oh, so I'm going to throw this one out to clients, and maybe advisors can learn from this too. But the way I like to think about insurance in general is that it is a pooled resource. And very much in the same way we use GoFundMe, where, it's kind of a post-event community resource. Insurance is more of a pre-event community resource. So in other words, it's still a bunch of strangers helping each other out. We're all putting our money in the same pot. Yes, there's a C-suite involved at the insurance company, but guess what? There's one at GoFundMe too. And so what happens is your money is being used for claims. The majority of your money is being used for claims. And you'll see this kind of the terminology for that is a loss ratio, which a lot of people are familiar with. And so the loss ratio for disability is kind of all over the place, depends on the carrier, depends on the state. California, they have to publish it on the illustration. Last I saw, it was just over 60%, which means that for every dollar of premium that that company collects, they pay out over 60 cents back to people who have these policies. And then, yeah, there's 40% margin that they keep. And they use that for distribution methods and for underwriters and for claims adjusters. So that's all part of that 40%. The 60% goes directly back to the policy holders. So it's people. So the majority of the money that's paid into, from your premium dollars into your policy, if your policy's, $2,000 a year, over $1,000 of that, maybe $1,200 of that is going back out to people in probably their greatest moment of need. And I just pause there because that's like, I just feel like people overlook this. Like what's in it for me? I'm buying this for me. And I'm not saying, you want to buy insurance charitably and spend more so that more people can tap into this coverage. That's kind of a silly way to look at it. But understand that when you're spending money on this insurance that you truly do need for yourself and for your family, that more than half of that premium that you're paying is going to help people in their hardest moment. And to put food, quite literally put food on the table for people who are struggling through a major health event. And I feel good about that at the end of the day. As a client who has my own disability insurance policy, but also somebody who helps put these policies in force for other people. I think that's, you know, we're not just helping those clients that are purchasing from us, but we're adding to the pool, understanding that, more than half that money is going to go out to people in need this year. So there's more to the story than just insurance and coverage and premiums. This is really a human thing, and we just constantly overlook that in the financial services realm. So hopefully that changes somebody's opinion about how to look at DI, and maybe we have a little more curiosity about the humanity behind this stuff instead of just the numbers.
Yeah, well, that's a great way to close the show. I like benefits are paid at your moment of greatest need, and that's something to think about with any type of insurance. Is yeah, claims can be a little bit of a pain depending on the type of coverage, depending on the company. But when you do have a claim paid, the carrier doesn't send it to you in installments. They don't send it to you in Bitcoin. They send you cash that you can spend right away. And that's the point of insurance, is that you're protecting against risk. Think of insurance this way: as a huge rainy day emergency fund. You keep your emergency fund of maybe $1,000 to cover, like, I don't know, car repairs or whatever. But a disability insurance policy, all it really is a gigantic emergency fund for that rainy day when you hope you will never need it. That's that's the other thing I hear with insurance that I'm sure you've heard too, is like, boy, I'm paying all these premiums, I'm not going to get anything back. Well, that's great. Shouldn't you be happy that you weren't disabled? That you didn't have a disability, you didn't have a like a life-threatening medical emergency. I would think that's a good thing in my book.
Yeah, I would agree. I would agree. I don't run into too many people who are disappointed about spending 40 years of DI premiums, oddly enough, because like you said, there's gratitude for their good health and that they never had to use this stuff. But I do see that a ton on the long-term care insurance side. So maybe that's the next episode where it's like, well, I paid into this forever. Damn it, I'm gonna use this thing one way or another. And so, there's a lot to be said there for the hybrid policies that are that have taken the market by storm, because they have a death benefit included in them that, ensure that you get something. And usually, hopefully, that's more than the premium you put in, but not all the time.
Well, here, not, we do need to close the podcast, but I do want to put in a rejoinder there for people to think about when you're thinking about whether or not you should get cash back from an insurance policy, whether it's a long-term care policy, life insurance policy. Are you upset with your homeowner's insurance policy that you don't get anything back at the end of the year if your home doesn't burn down? This is insurance marketing. And some of my guests talk about psychology and money. This is psychology at work because, like you're talking about, nobody's had a disability insurance policy. I haven't talked to anybody who's had a disability insurance policy for 40 years and been bummed out that they didn't get a claim. They've been very happy that they were healthy for 40 years and claim free. So it's a marketing thing where you think you need to get something back from your insurance policy because that's the whole point. If the insurance company has to give you something back, they are going to charge you for it because, as you said, the insurance company has their own costs of running their business. So to close out, Max, where can listeners learn more about you, follow you on social media, find out about Dingo Technologies and Net Worth?
Sure. So LinkedIn's probably the best spot. That's where I'm most active for sure. So Maxwell Schmitz, whatever LinkedIn's handle is /Maxwell Schmitz. And then I also lead a weekly study group for people who want to dive deep on DI. That was a lot of alliteration, but for those who really do have a genuine curiosity in learning more about disability income, I'd say join the Dingo study group. You can do that at dingoinsurance.com. There's a link there to join the study group. Might have to fish around for that a little bit, but it's there. Or just find me on LinkedIn. I post about the topic every week, so you don't have to scroll too far down in my my posts history to see how to get involved with Dingo study groups. So yeah, so those are probably the two main things. And then I have a newsletter. It's a closed newsletter right now. I'm thinking about opening it back up. So just a heads up there. But that's called The Nutshell, where we just talk about it's kind of actually in reference to this little guy. This little nutshell is kind of our thing, but we just do a summary, a weekly recap every about post of the week, case of the week, kind of a yet worth update, and then a market update on all things disability and long-term care. So keep an eye out for that too.
Awesome. And for everybody watching and listening, if you have access to the show notes, all of these links will be in the show notes, so you can reach out to Max there. And if you do want information about the Dingo study group, you can also DM me on LinkedIn, and I can get you the link for that. So Max, thanks again for joining us today and for sharing your time and insights.
Oh, thank you. I hope a few listeners here made it the full hour, and I look forward to anyone who wants to learn more about this stuff. So thanks, Tony.
Yeah, and thank you everyone for tuning in to this episode of Get Ready Before Life Happens. I know episode was a little bit longer than usual, so if you, as Max put it, if you did bear with us, thanks for hanging in there. And if this did help you change the way you think about disability insurance and income protection, please be sure to subscribe and share it with a friend. You can also go to my website at tonystewart.com to join the Get Ready movement and get access to a whole bunch of free resources. Until next time, let's change the way we think about money.